Every systemic breakdown announces itself through the same sequence of events. First, stress accumulates beneath the surface while official mechanisms maintain an appearance of normal function. Then, emergency measures emerge to prevent visible failure while transferring risk to areas where it's less observable. Finally, the underlying problem grows larger and more unstable until emergency measures become inadequate and breakdown becomes inevitable. The silver market has just moved through the first two phases of this sequence. What appeared to be dramatic price volatility was actually emergency intervention to prevent something far more dangerous, the complete collapse of paper silver price discovery. And the emergency measures that prevented immediate breakdown have made eventual breakdown mathematically certain. While attention focused on silver's spectacular crash from $120 to $78, the real story was unfolding in delivery mechanisms, inventory reports, and institutional positioning that reveal how close the silver market came to complete systemic failure. The U.S. government's emergency response exposed just how fragile the silver pricing system has become. More importantly, it revealed why that system cannot survive much longer under current stress levels. Today, we're going to examine the evidence that shows the silver market is breaking down in ways that make price movements irrelevant compared to the underlying structural changes that are about to transform silver from a tradable commodity into a strategic resource controlled by direct ownership rather than market transactions. The emergency move, what they don't want you to know. While mainstream financial media explained silver's crash through Fed policy changes and margin call technicalities, the real emergency response was happening through channels that most market participants never see. The Commodity Futures Trading Commission issued emergency authorization for extended settlement periods on silver derivatives contracts that were approaching delivery dates with insufficient registered inventory to fulfill physical delivery obligations. This emergency authorization prevented immediate default on silver futures contracts by allowing cash settlement at artificially suppressed prices rather than requiring physical delivery that couldn't be completed with available inventory. But emergency cash settlement authorization reveals that the COMEX silver market was hours away from delivery failure that would have exposed the mathematical impossibility of maintaining current paper-to-physical ratios. Between early and mid-January, 3,345 million ounces of silver were physically withdrawn for delivery from COMEX. That represented roughly 26% of registered inventory disappearing in a single week. When over a quarter of available delivery inventory disappears in 7 days, while new futures contracts continue being written at multiples of remaining physical inventory, the mathematics become unsustainable within weeks rather than months. The emergency measures prevented immediate recognition of this mathematical impossibility, but they couldn't solve the underlying problem. Demand for physical delivery exceeding available physical supply by margins that cannot be resolved through normal market mechanisms. The inventory crisis, numbers don't lie. The most revealing evidence of systemic breakdown appears in inventory data that shows silver transitioning from abundant commodity to scarce strategic resource. A significant portion of what is reported as registered silver is either non-eligible or already encumbered in some way and thus not truly available for delivery. The pool of actually deliverable, fully eligible silver is much smaller than the headline figures suggest. This means that official inventory reports overstate available silver supply by significant margins. When traders demand physical delivery based on published inventory data, they discover that much of that reported inventory cannot actually be delivered. But the inventory crisis extends beyond COMEX warehouses to global supply chains where industrial users are securing silver through direct ownership arrangements rather than relying on market availability. Samsung C&T finalized a mining prepayment deal that provided a $7 million prepay offtake facility to restart the La Parrilla silver mine in Mexico. With one crucial clause, Samsung obtains the exclusive right to purchase 100% of the mine Etudeo's silver-lead concentrate output for the next 2 years. This represents resource lockup rather than market-based procurement. Samsung didn't buy silver through exchanges or negotiate competitive pricing. They secured exclusive access to entire mine outputs through financial arrangements that bypass price discovery mechanisms entirely. When major industrial users abandon market purchases in favor of direct mine ownership or exclusive supply agreements, it indicates that market availability has become unreliable for essential business operations. The strategic shift from commodity to strategic asset. The most significant development in silver markets isn't price movements or trading volumes. It's the fundamental shift in how sophisticated buyers approach silver acquisition. Emerging market central banks may have acquired several 100 million ounces of silver via routes that bypass traditional market mechanisms. Silver is increasingly discussed as a potential foundational asset in a future BRICS monetary system. Central bank accumulation through non-market channels indicates that silver is being reclassified from industrial commodity to monetary and strategic asset that governments accumulate for reasons beyond commercial use. But central bank accumulation represents only one category of strategic demand that's removing silver from market availability. China's reclassification of silver as a strategic material, restricting exports, has fragmented the global market and exacerbated supply shortages. When major producing countries restrict exports and reclassify materials as strategic resources, global supply becomes subject to geopolitical considerations rather than market economics. These strategic reclassifications create supply constraints that cannot be resolved through price increases because the constraints are political rather than economic. The nuclear factor. Demand that cannot be substituted. Beyond industrial and monetary demand, silver faces new demand sources that are both massive in scale and completely inelastic with regard to price. Nuclear power revival creates significant demand for nuclear reactor control rods that require high purity silver. This demand is completely inelastic. Nuclear reactors require specific silver specifications that cannot be substituted regardless of price. Nuclear energy expansion creates silver demand that must be satisfied regardless of price, because nuclear reactor safety systems cannot operate with substitute materials. As global nuclear capacity expands to meet energy security objectives and carbon reduction targets, nuclear silver demand becomes a fixed requirement that competes with all other silver uses on a must-have basis. This inelastic demand creates permanent removal of silver from supply available to price-sensitive industrial applications and investment markets. The AI and data center revolution. The most explosive source of new silver demand comes from artificial intelligence infrastructure expansion that requires massive data center construction with silver-intensive electronic components. AI's massive expansion has fueled demand for metals in the data centers that power the growing technology. Data center construction represents silver demand that grows exponentially rather than linearly. Each new generation of AI processing requires more sophisticated electronics with higher silver content per unit. But AI data center demand differs from traditional electronics demand because AI systems operate continuously at maximum capacity rather than intermittent use patterns that characterize consumer electronics. This creates silver demand that is both massive in immediate scale and permanent in duration because AI data centers consume silver-intensive components continuously over multi-decade operational lifespans. The mathematics of inevitable shortage. When you combine strategic accumulation, nuclear requirements, AI infrastructure demands, and traditional industrial uses with constrained supply and export restrictions, the mathematics become clear. Price increases cannot quickly rebalance the market. The traditional playbook, high prices rapidly stimulating supply and suppressing demand to restore balance, becomes slow and inefficient. The market can only plug the gap by chewing through above-ground inventories until those stocks are exhausted. This analysis reveals why emergency measures were necessary to prevent immediate market breakdown. The mathematical relationship between available supply and inevitable demand cannot be resolved through normal price discovery mechanisms. Emergency cash settlements and extended delivery periods provide temporary relief by reducing immediate delivery pressure, but they don't create additional physical silver or reduce strategic demand that must be satisfied regardless of price. The positioning reality, smart money already moved. While retail investors focus on price volatility and technical analysis, institutional positioning data reveals that sophisticated buyers have already repositioned for supply constraints that make current prices irrelevant. Tech giants like Samsung and Tesla are securing physical silver through direct deals, bypassing exchanges, signaling a shift to vertical integration. Vertical integration means that major silver consumers no longer trust market availability and are securing supply through ownership rather than purchases. When companies with multi-billion-dollar operational requirements abandon market purchases in favor of mine ownership and exclusive supply agreements, it indicates that market supply has become unreliable for essential business operations. This institutional behavior change happens years before supply constraints become obvious to retail markets. By the time a shortage becomes visible through price signals, physical silver has already been secured by entities with essential requirements and sufficient capital. The price discovery failure. The most significant implication of recent emergency measures is that they revealed price discovery failure rather than price correction. Normal market corrections occur when prices become disconnected from fundamental value, and market mechanisms restore proper relationships between supply, demand, and price. But emergency cash settlements that allow contract resolution without physical delivery indicate that price discovery cannot function normally because physical delivery cannot be completed at any price within available inventory. When markets require emergency measures to prevent delivery failure, it means that paper prices no longer reflect physical availability. Price discovery has become disconnected from physical reality. This disconnection accelerates because emergency measures encourage additional paper contract creation while physical supply becomes more constrained through strategic accumulation and export restrictions. The international dimension, global supply chain breakdown. Silver market breakdown isn't limited to U.S. futures markets. It's manifesting globally through supply chain disruptions and international market segmentation. China's export controls fragmented the global market and created regional supply shortages that cannot be resolved through international trade. Market fragmentation means that silver shortages in consuming regions cannot be resolved through imports from producing regions because export restrictions prevent free trade. This creates regional markets where silver prices reflect local supply and demand rather than global supply and demand. When global markets fragment, arbitrage opportunities disappear and price disparities become permanent rather than temporary. Regional market segmentation accelerates strategic accumulation because buyers cannot rely on international supply to meet requirements during shortage conditions. The timeline: why breakdown became inevitable. The sequence of events that led to emergency intervention reveals why silver market breakdown was inevitable rather than possible. Industrial demand growth exceeded mine supply growth for consecutive years, while above-ground inventories declined through investment demand and strategic accumulation. Export restrictions and strategic reclassifications reduced internationally available supply, while AI infrastructure and nuclear energy expansion created new demand categories that cannot be substituted or delayed. Emergency measures prevented immediate delivery failure, but couldn't address underlying mathematical imbalance between available supply and essential demand. The timeline reveals that breakdown was prevented temporarily through emergency intervention rather than resolved permanently through supply and demand rebalancing. The next phase: what emergency measures cannot prevent. Emergency cash settlements and extended delivery periods provided temporary relief by reducing immediate delivery pressure on constrained inventory. But emergency measures cannot create additional physical silver, reduce strategic accumulation requirements, or eliminate essential industrial demand. They can only transfer shortage recognition from immediate to future, while underlying shortage conditions continue worsening through continued demand growth and supply constraints. The next phase will occur when emergency measures become inadequate, because shortage severity exceeds what can be managed through delivery deferrals and cash settlements. At that point, silver markets will transition from emergency management to acknowledged shortage, where physical availability becomes the primary constraint rather than price levels. The strategic response: what sophisticated buyers already know. While retail investors debate price charts and technical indicators, sophisticated buyers are responding to supply constraint reality through strategic repositioning that bypasses market mechanisms entirely. Direct mine investment, exclusive supply agreements, and vertical integration represent recognition that market availability has become unreliable for essential requirements. These strategic responses accelerate supply constraints for remaining market participants because they remove silver from market availability on a permanent basis. When essential users secure supply through ownership rather than purchases, remaining market supply becomes concentrated among non-essential uses that can be eliminated through price increases. The ultimate outcome: physical reality overwhelms paper. Promises. The mathematical outcome is inevitable regardless of emergency measures or price manipulation because physical reality cannot be altered through financial engineering. Silver supply is constrained by geological reality, mining capacity, and geopolitical decisions that cannot be changed through market mechanisms. Silver demand includes essential requirements that must be satisfied regardless of price and strategic accumulation that remove silver from market availability permanently. When essential demand exceeds available supply, while strategic accumulation continues, market breakdown becomes mathematical certainty rather than possible outcome. Emergency measures can delay recognition of this mathematical reality, but cannot prevent its eventual manifestation through supply shortage that makes price discovery impossible. The warning: why this changes everything. Silver market breakdown represents more than commodity supply shortage. It represents the beginning of strategic resource scarcity that will reshape global industrial and monetary systems. When essential materials become scarce enough to require strategic accumulation and emergency market intervention, normal economic relationships break down and resource control becomes more important than financial assets. This transition affects every industry that depends on silver for essential operations and every monetary system that relies on abundant commodity supplies for price stability. The silver market breakdown is the early warning signal of much broader resource constraints that will define the next phase of global economic development. Understanding what happened in silver reveals what's coming for other strategic materials, as global competition for essential resources intensifies beyond what market mechanisms can manage. The breakdown has begun. The emergency measures are failing. The strategic phase is starting. Silver wasn't just crashing, it was breaking free from a system that could no longer contain its true scarcity. And that breakout is just beginning. The price was the distraction. The shortage is the reality. And reality is about to become impossible to ignore. Something big is breaking in the silver market. But it's not the price. It's the entire system that pretended silver was abundant when it's actually becoming the scarcest strategic material on Earth. The emergency move exposed the truth, and the truth changes everything. The silver market as we knew it is over. What comes next will make everything else look like preparation